Welcome to our fourth quarter update here at Greenleaf. Today, we're going to go through the residential segment. We're going to touch base on what we are seeing in the market and how our properties are performing. So to kick things off, we're going to go over just the general market conditions and what we're seeing out there. And let's start off with the kind of the demand side, where things are at.
Yeah, so the national vacancy levels seem to peaked out around 5%. So occupancy around 95%, vacancy around 5%. So it's just a good guidance of like where supply demand is falling in the market. Um, a lot of what's really driving rental demand is really affordability on housing. In the last 3-4 years, housing prices have gone up 51%.
Yeah, that's like the national average of how much they've gone up. So housing costs, it's definitely no secret that home prices have really ballooned over the past 4 years, and rising home prices just makes it harder to buy stuff, and then therefore there's more people in the rental pool.
Yeah, well, the combination not only with housing prices going up 51% since 2020, but you also have interest rates doubling. So now you're talking about like a monthly mortgage payment going up by three,
Yeah.
4 times in that time period.
Yeah, it's the first time really now that it's definitely much more expensive to buy something than it is to rent it. But the demand is still going to the buy side, and a lot of people already have that home. You know,
Right.
so it's there.
I was looking at some charts showing kind of the spread of rent to affordability of rent compared to affordability of housing. And the last time the spread was this wide, and this has been the widest it's been for about 20 plus years. The last time it got close to this wide was in 2006.
Yeah. So maybe some indications of where that is heading. But another thing we look at a lot too on the demand side is just construction permits. At Greenleaf, we're not doing any new construction of apartments. We've always been buying older stock, renovating it, and trying to add value through that process. So we've never been a build group. However, we always look at what are the new permits and new construction, what deliveries are coming online. A lot of times our buildings are around those assets, so it's important for us to know those rental rates. And right now we're seeing that new construction starts decline pretty hard, right? So they've come down drastically since really the trend has been building downward since 2022.
Right. And the key thing here is like a new construction start, the delivery isn't for 3 or 4 years from now. So what's being delivered today was a new construction start in 2021 or 2022 being delivered today. So in Atlanta, for example, on average, they're delivering about 15,000 units a year, but those were all construction starts from a couple of years ago. Now that's all kind of tapering down, and we'll probably see that start impacting the market in 26, 27, probably not in 25, because
It takes time.
those buildings are already basically built.
Yeah. There's definitely things that are pushing for there to be more demand on the apartment housing side. And it's kind of that kind of joke of like, oh, you need a place to live all the time. It's like, yes, however, that doesn't necessarily mean the market just goes up forever.
Right.
But let's look at some other parts now that we think are like hurting prices, right? So a lot of these new constructions that did start in 21 or 22, they were built at a time when models were projecting 10% revenue growth, and that was going to go indefinitely. And we started talking about that really at that time. Like we do not expect revenue gains to just keep going up and up and up and up. And so now we're seeing for the first time that, especially in the Atlanta market, we mentioned it last quarter that rental rate gains were negative. They were negative again in the fourth quarter and now negative for the year, right? So they were down 1.7% in Atlanta. That was when we look at that. So, and then also with supply ballooning, right? The deliveries right now from new starts 2 years ago, those were also done when interest rates were a lot lower, and they're now rising. And they were done when costs were really at their peak. So we'll look at some charts where we see like, look, interest rates are going up, costs were up, they're coming down a little bit. So you've got some really expensive stuff that came online.
Yeah. So in terms of the rental rate growth, what we're seeing on our assets and also tied to the rest of the market is that kind of C assets, B minus C assets, they're still going up a little bit. We're seeing 1 to 2% rental growth on those that part of the market compared to the Class A assets that are seeing softening.
Getting into specifically the Greenleaf portfolio, when we look at our occupancy, we touched on this in the third quarter that they passed some new eviction laws really in focused in Atlanta. really. And that law basically said that if a resident was not going to make their rent payment, uh, they could halt the eviction, but they had to make their payments to the court. And if they didn't make their payments into the court system, that you could go direct to the sheriff to get the eviction. That's simplifying it. There's some other rules in there, but it enabled the eviction process to be sped up, which was, we had people that it was taking around 2 years. So it was a lengthy, very lengthy process for the city. And now that's been sped up a bunch. So we saw a lot of vacancy occur in the third quarter as we were kind of cleaning that out. And we dropped down to 87% in the third quarter, and we're back to 90% in the fourth quarter. There's only so much occupancy you can gain in one quarter at a time. You can't just lease every single thing at a day's notice.
There's still turnover costs. No matter how good the quality of the unit is, you still have to clean the carpets, paint the walls, inspect the unit. It takes a little bit of time, and then you have to market the unit and tour it and sign a lease. Like, none of this stuff happens overnight. So probably best case, you're looking at like probably 3 or 4 weeks of downtime.
And, on top of that, on our mobile home side, our mobile home communities, that occupancy has stayed predominantly flat over the past 4 years. It was steady again in the fourth quarter. We're sitting right around like 97.5%, and we've been there for a while. It's a slightly different product, though. Most people own their home and are renting the lot. So that business over the years, we've stabilized that one, and it's had very stable occupancy. So what that means for our revenue growth, when we go back in time and look over the past quarters, we have seen our apartment revenue increases declining. The market has seen negative rental rate, whereas we have seen about 3% rental rate growth for the fourth quarter. We're going to put this chart up, and this shows really our apartment quarter over quarter revenue change. So this is saying the fourth quarter of 2024 was around 2.5% revenue increase compared to the fourth quarter of 23. So it's going back a year in the quarter. Now, if we look at that every quarter going back in time, we've consistently seen that these increases have declined. So this is where when we talk about downward pressure on rental rates, it's there. However, we're definitely outperforming where the market is. The market at the same point in the fourth quarter and for all of 2024 in the Atlanta market was negative 1.7%.
Basically, occupancy trends being inflated because of this eviction lag, right? So if you have longer-term tenants that aren't paying rent, that are staying in the unit, occupying the unit, and we're not able to evict, that's basically driving up occupancy, but not driving up revenue. It's really hurting revenue.
Correct. Yeah, and we even look at it a little bit differently because we're talking about our revenue gains, not just our rental rate gains. So to have revenue gains, your rental rate gains have to be higher. So leases are turning over once a year. So let's say your rental rate is $1,000 a month and it goes to $1,050 a month. That's a 5% rental rate increase. That doesn't necessarily mean your revenue increases for the year would be 5%, because you think about that, that lease turns over somewhere in the year and at some point in time. If it's done in June, then it's going to be 2.5% rental revenue increases for the year. So we had 2.5% across our portfolio in revenue increases. So our rental rates were a little bit higher than that.
And not every lease is turning over, or we're seeing that, when we see a renewal, we're getting, say, 5% increase on renewal. We're seeing a full turnover. Yes, we're putting a lot of money into the unit for turnover. We're seeing more like 15, maybe even sometimes 20%. That's only happening on a small part of the portfolio. So blend a 2 or so % increase.
Correct, on revenue. So we're seeing that we're definitely outperforming the market as a whole as to where our revenue targets and our rental rates are. So we're excited about that. That's good for our assets. It shows that our team, we are vertically integrated. Our team is doing a great job on the property management side of maintaining this stuff. When we look at the expense side, we can trend in and look at a little bit about what we're seeing there. So put these two charts up here, and this really shows what our expense growth looks like on specific properties. So one of our assets, Park Hill, we look at 2024, we basically saw flat expense growth. Now, 2023, it was up a lot. So it was flat in 2024, flat at the end of the year, which is positive, but it's still really high compared to where it was. Look at 21, 22, 23, we just kept seeing expenses kind of ballooning.
And to talk about expenses, right? We have two categories of expenses that on how we operate. We have controllable and non-controllable. Controllable are things that we feel like we can control, right? So staffing, how we staff the properties, how much water usage we have by, putting low flow devices in, how much power consumption we have, et cetera, material supplies, all those things. Non-controllable are kind of completely out of our hands, basically taxes and insurance. We have, short of lobbying the
Yeah,
state.
there's things we can do, but it's not necessarily a controllable expense. So we look at those as non-controllable.
Right. So when we're looking at total expenses, it's really a blend of all those things. When in general we have seen increases on non-controllable, we've gotten more efficient, but we have not. But those increases have been very, very small relative to non-controllable expenses.
Yeah, yeah. The non-control, when we look at those, the taxes and insurance are going to be a huge part of real estate investing over the next 4 to 5 years, and finding really creative ways or ways where you're taking on a lot more risk to be able to execute a real estate deal. We've talked about this some before, just the amount of properties that don't have insurance or do not have insurance that fully covers what could happen there. Uh, in those situations, we've chosen to exit those deals. In Georgia, some assets, it's very hard to get assault and battery coverage, which is if there's a crime, a violent crime that happens at a property, are you fully liable for it? A lot of times that's coverage is hard to get in Georgia. If we have that happen on one of our properties, we're then going to look to sell the deal. We're only really holding assets that we know we can have insurance on. And there's another issue too of like, does your insurance actually cover the replacement cost of your asset? And will you be able to build it back? Not all policies are able to do that. That's another indicator. Like we with a syndicated investment pool, not comfortable with taking on that unknown risk. Those are deals that we would exit as well.
Right. And there's an interesting map of the United States showing really coastal regions like California with the current wildfires, like Florida, and really parts of the East Coast along the coastal line that have been hit by hurricanes, that you're seeing a much higher density of people that are not insuring their properties anymore, or they can't get insurance.
Right. Yeah. It's definitely going to be a challenge, but it's going to trickle through all real estate investing. I think it's going to be one of the biggest issues that you're facing in a real estate deal. It's not necessarily like, hey, what's your just cost per unit on insurance? Like, that's not a good answer. That's not a good question anymore. You need to really understand how that insurance works and what risk you're at on each deal. And it's deal by deal, and there's there's a bunch of different ways you can look at these things, but it's gonna be a highly important part of the real estate investing process over the next years.
Yeah, the details of insurance, like for example, in Florida, the carve-outs are really interesting. You can get flood, but you can't get wind. And in California, you can get property insurance, but you can't get fire insurance. So these major catastrophic events are frankly not going to be covered with your basic insurance policy. There's going to have to be some kind of federal program that come and bails them out.
Yeah, and you might think, hey, why would you need flood insurance? Even in Atlanta, why do you need flood insurance? Well, we have streams and infrastructure in Atlanta that have been built up over the years. And, houses get closer and closer to these streams, and you kind of mess with the banks and the stream floods. We've had multiple properties that we have flood insurance on that have had floods because they're close to a river, close to a stream, or something that overflows, something gets backed up. We have one, this goes back to the Whiteford deal. I mean, it's a while ago, but a dump truck backed up and the dumpster fell off and blocked up a bridge and flooded the whole backside of the property.
We cannot make this story up.
It's like, how's that even happen? Like the dump truck's driving, the dumpster falls off, goes in the creek, blocks the culvert that's going under the bridge, and the whole area floods. We have flood insurance because it's in a flood zone property. So we're lucky we had that there at that point, because crazy scenario that kind of plays out.
Right.
But so now, the part we want to talk about, just before we go into just more deal specifics, is when we look at how certain deals are performing. Right, we've talked about this some, but we use an operating metric called operating return on assets. And we're going to put up two charts here that we can really look through, and we're going to show two of our deals. The first one here is Eastside Crossing. This is a deal that well, it's on Sugar Creek. It's another one
There's
that's
some flood insurance.
yeah, it's another deal where we've got a creek going by it. But we look at our operating return on assets, and what we're really looking at here is the total asset value, and then we divide our key metrics and performance numbers by that. So we've got four that we're really looking at all the time. It's revenue. So this gray line is what percentage of the asset are we receiving in revenue on a yearly basis. And then we go into return on equity, how much equity we have in the deal, how much we're going to earn on that. What is our operating margin? So we look at free cash flow, whether it's called a controllable and non-controllable expense, a capitalized expense, interest, whatever you want to call it. It's money that is out the door to someone else, and what's left over, that's our operating return on assets. And then we look at another one, orange, where we include the debt payment if we're paying down principal. We've always had the premise that we want to be making principal payments on loans. For years, that kind of got us not into some deals because our philosophy being conservative on the debt front with fixed debt and paying principal. So that's what we're looking at here. And you can see at this deal, Eastside Crossing, it's fairly stable. We're seeing slight increases each year. We look at our operating return on assets. And again, these numbers aren't enormous, right? But we're in like this 2 to 2.5%, and it's trending upwards. And we see our annual, return on equity in the high single digits and consistently going up. That's where we see we have a deal that we're able to reinvest in. We're able to continually grow revenue. We're able to continue to perform. We like holding those deals. When we look at our charts and our numbers and it tells us how we're doing, we go to the bottom. Want to show you another chart here. This is City View. This is a deal we own up in Chattanooga. And really 23 and 24, we face some challenges there. And you can see that from, we had revenue growth, right? That was going up. You can see 17, 19, 20% revenue on asset value, which is a good trend. However, 23 and then in 24, we really saw our operating margins contracting. And it's like, wait a minute, here we're getting to the point where the deal's not going to make any money. You can imagine what happens when the numbers go below zero. But that's not the goal. That's a bad situation. In 2025, we're projecting that we're going to be able to turn things around a little bit, but we've always been well occupied here. We've always had strong retention rates. We've just had maintenance issues that we have to tackle. Right now, we're going through a lot of plumbing work on this deal specifically, and it shows in 2024 where we saw our operating margins really decline.
Yeah, probably like this that was built, call it 50 years ago, with terracotta pipes, basically clay pipes. So the sewer lines, instead of them being cast iron, which is better than clay, not great, but still better than clay. The modern day of doing it is usually PVC or some version, a plastic version that basically lasts forever. These terracotta pipes are really just eroding away, and kind of just the sewage is basically backing up and seeping into the ground until it just overflows. So we're going through one by one, building by building, and replacing that kind of main sewer line out of the building. And there's 14 buildings here. So, it's give or take a $20,000 expense on a property like this that, times 14 over years. It hurts us in the short term. Long term, it's a good investment for the property to stabilize it. But in the short term, it really hurts our cash flow.
But it has to be done.
It's
not one of those things you can skip out on, or you're gonna have this balance of, hey, I don't want to fix this thing, and then I'm not gonna have any occupancy,
right?
And you're gonna be in an even worse shape, right? So these two charts, this is really how we look at how is the deal performing, and when we talk people like, look, do we feel like we're bullish on this asset? We want to keep holding it, or is it like, hey, we got to think about this one, and the numbers are showing things in the wrong direction. So a couple deals going into the end of 2024, we start seeing some trends just from what we talked about earlier, the market as a whole and where it's at, that are showing our aura numbers trending in the wrong direction. So a few of those deals we're going to look at exiting in 2025. We really started that process in 2020 when I feel like we were complaining about tax insurance in 2020, and it's only snowballed since then. And since that time frame, we were at about 4,000 apartment units, and we've sold down to about 1,500 in the portfolio right now. And coming up for 2025, we look at the assets we do have. We're looking at things like our City View deal, things like Westside Townhomes. That's another project that we're taking out. In Fairway, we were looking at as well, where we see contraction of our ORA ratios, and then therefore it puts us in a situation of if it's not something we have a plan to go turn around, like what can we specifically do differently to improve these numbers? That's when we'll look at exiting a deal. Yeah. Okay, so let's go into distributions and what we're paying out on different projects here. A lot of our distributions are based on whether we're able to hit our reserve threshold. So this started really back in 2019, 2020, where our reserve calculation is the same on all of our deals. We want to have our target for the year is our taxes and insurance and 3 months of operating costs in our annual CapEx budget. So that's the number that we're trying to reserve for each year. So we look at what did we project things to be going into 2024? Like, okay, we think this is going to be the number for 2024. And now at the end of 2024, fourth quarter, what actually happened? Where were we? And what we saw was, on average, that calculation was about 15% below. Our projection was 15% below what actually happened. So our reserve numbers on almost all of our deals increased. We have this chart here that's showing our green line here is the per unit estimated reserve by deal. So you see that's in the green line. The blue line is how much did it change or increase for the year on a per unit basis. Now, we had 2 deals that we just mentioned, though, City View and Fairway, that actually went down, whereas almost all of our other deals, our reserve target increased. And you can see they're all pretty much in line. We've got 2 outliers in deals, but for the most part, they're right in line. And it's around $4,000 a unit in reserves that we need to have per deal.
And really the difference is from a controllable expense standpoint, all of our deals are within, give or take, a 10% margin of each other. It's the big difference is really those non-controllables. When you see properties like 1209 Memorial and Westside Townhomes that have just property taxes just gone through the roof on those properties. And so those are the ones that we're looking at and saying, man, can we recover that much in rents or not?
Yeah. And a lot of times property taxes going up means they're based on values. So values went up a lot. That's good for the investment return, but Absolutely. It really hurts operating margins and operating returns in the current. So that's where we look at, okay, maybe we should take them out and capture that. It's typically an indicator that there is a big gain.
Yeah.
So we'll be able to have that there. However, the real-time situation is challenging. We talked about the market as a whole. We are not able to pass through dramatic tax and insurance increases in rent each year. It's not going to happen. We tried that on our Kingstown property, which we sold in the we sold it at the end of the third quarter.
Yep.
Right. Where we could not pass through the level of tax increase there. So we took the gain and redeployed those assets. We'll do similar things on these deals. If we do not feel like we can get the revenue, if we cannot turn around our margins, that's where we'll be at.
Yep.
So on the distribution front, a lot of our deals are, because of this reserve target, behind on their reserve threshold. And that means we only have a few deals that are making consistent distributions this quarter across really the apartment and the mobile home space. So that is a challenge we're facing. We're trying to look at 2025 and saying, what are we going to do to, one, turn these things to be able to capture the revenue needed, but the market is not really there for it right now. We're definitely beating the market on what our revenue gains are and our rental rate gains, but the market as a whole is negative when they are also seeing tax insurance increases. Right. So if we think about the main deals that are making distributions, we look at our Eastside Crossing deal that has been doing very well. We look at that chart; it's performing well. On the mobile home side, our Russell Village deal, which is a mobile home park where we were able to get Fannie Mae debt on that one. We have great long-term debt there. Continue to make distributions on that deal, so that's very exciting. We have got one mobile home park that we're actually redeveloping. So we're in the middle of that process right now. We're working with a development group to build townhomes on that one, and we're getting through our final plan. So we're not making distributions there. However, we're really excited about the progress we're making on the development front.
Right, and we were talking about the difference between paying out, which basically means we've met our reserve thresholds, and positive cash flow. just because we're not paying out doesn't mean we're not earning positive cash flow. Because as you can see, we're contributing to our reserves. We're building more reserves. We're just really protecting the asset more as property taxes and insurance increases. And what we're hoping for is a sunnier day in the future that rent growth will outpace this expense growth.
Yeah, or we just see a normalization of property tax rates and values and insurance costs. But yeah, we're positive cash flow, but we just can't catch up to the reserve numbers on a lot of our deals. Right. So obviously investors, everyone wants distributions. We want cash flow not only to the deal, but cash flow out of the deal to investors. That's really how the game works. So making partial distributions is not super exciting from an investment standpoint, but we are positive and building our reserves. It's just, we look at some of these like 1209 Memorial. If our reserves are, the green line is our target on these. We have some pretty healthy reserves that we have. It just doesn't mean we can distribute money conservatively while running the deal.
And all the reserves, this is literally cash reserves, and as often as possible, we're putting them in interest-bearing accounts. But a lot of them are held by Fannie and Freddie, right? And yes, they're getting interest on those as well.
Minimal compared to what we can get at a real savings account.
Right, but so we are doing more than nothing in this category.
Yeah,
but it's still it's still a challenge.
So that's where we're at on the distribution front, and again, all of our stuff that'll go out on the 20th has the distribution notices in it, so you can easily see where they are per deal. As we look ahead going into 2025, we mentioned 3 deals that if we see Aura trending in the wrong direction, we've got 1 or 2 years, like we can see where it's going. We're going to look to exit those deals and take that capital gain that is there. Some other trends we want to touch base on as we go into 2025 is we expect to see revenue growth really through gaining more occupancy. Even though the market is saying otherwise, the market is saying vacancy is 12% and revenue or rental rate growth is negative 1.7% in Atlanta. We're at 90% occupancy. We expect to get back up to 95% occupancy this year with that change in the eviction rules. And we do expect to see positive revenue gains, which we're estimating around 2.5% in 2025, which means we're really seeing like 10 to 15% rental rate gains on the portfolio. So that's what we're targeting. However, even with pushing on this, we don't know if that'll actually meet our reserve targets of what will happen with taxes and insurance. Right. So we expect good numbers on our performance. We have been hitting over 70% retention consistently, so we're really excited on that front. Like that's performing well. But taxes and insurance are going to dictate whether we can hit our reserve numbers.
I mean, that retention number is really driving our controllable expenses, right? So if our retention was say closer to 50%, we'd be spending a fortune on turning over more units. The average turn is now costing us north of $3,000 a unit. That's probably up from $500 from 7, 8 years ago, or when it used to be free when you and I used to go.
There was that part of it too.
But capturing that rental rate growth is and controlling expenses on turnover by maximizing retention is really the name of the game right now.
Yeah. So even with where we're at, we're still expecting to see about a 13% expansion of our NOI margin. End of day results of the deals being more profitable. So that's what we think on average is going to happen. So we're still very excited about that. Other trend, and I feel like we've been saying it for a while that there's going to be some headwinds, but it looks like they're actually here right now. So we think that if you're an operator and you're seeing 12% vacancy and you're seeing declining rental rate growth and costs that are going up, at some point you're going to decide, hey, do I want to sit on this vacant unit or I just want to rent it for what I can get? And that we feel like adds more downward pressure on rental rates in the market as a whole. So we expect that to happen, and we expect that there are going to be some operators that are in a challenging position with some of these deals if they base their numbers on 2022 with 10+% revenue gains, 97% occupancy, and it's basically like trees are going to the sky.
Right. Yeah. It's interesting. Atlanta has about 40,000 college grads that get employed by the city, by the metro area every year, which is a very positive thing for occupancy and rental rate gains. The interesting is that the student loan deferment plan that ended at the end of 2024 is coming back, and as
For
soon as that
2023. Yeah, well, it just ended.
it just ended, in the last month. So they're, from a macro level, they're expecting to see rental rate declines as a result of that. That students will have to start paying their student loans again, so they can't afford to pay these super high rents. So it'll be interesting to see, as more college grads move to the city, which is a great thing, but affordability is being hurt as well.
Yeah. So overall, we're looking at our assets that are performing well, and we're able to see financial situations that we like. We're going to keep holding those. We're going to keep operating. If we start seeing trends that are continuing to go the opposite direction, mainly because we see outsized tax, we see outsized insurance costs, we're going to look to exit those deals. The other part that we see on the insurance front is just the complexity of it and whether it actually meets all your covenants with your loans. That's a hard part of it too. So even if the insurance cost is affordable, it's like, does it really do everything it needs to do? You might not be able to get that either. you know? So when we think about what our trend looks like going into the first quarter, we're still bullish on what can happen. There's a lot out there that points to like there's going to be some challenges. However, strong operating teams can normally work through all that stuff. That's where we think that our numbers have outpaced the market numbers that have come in almost every quarter. Well, really every quarter in 2024. We saw higher occupancy. We saw higher revenue and rental rate gains than what was reported in the markets. We feel very strong on execution ability, but concerned on the tax insurance front as that just continues to put some headwinds in the market. Right? Okay. That is our recap for the fourth quarter on the residential side. Please let us know if you got any questions on this one. Happy to go through any of the deals in more specifics and just see how we are executing and operating. Really focus on trying to improve ORA margins on a deal by deal basis. Thanks, everyone.